Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Kyoto just raised its tourist accommodation tax to as much as 10,000 yen a night, one of the highest lodging taxes in the country. That's the easy part of investing here. The harder part is a building rule from 2007 that nobody asks about, but that quietly decides whether your property holds its value. First video in a new series, going city by city through Japan's real estate market. We're starting with Kyoto, heritage rules, high demand, and what that combination actually means for a foreign buyer's return. This is for anyone considering a purchase in Kyoto specifically, whether that's a rental condo for long-term tenants, a renovated Machiya townhouse, or a short-term rental play built around the tourist economy. Each of those comes with a different rulebook, and we'll walk through all three. Unlike most Japanese cities, Kyoto's housing market isn't driven mainly by local salaries or population growth. Tourism, university demand, heritage value, and a hard legal limit on new construction all matter more here than in an ordinary regional city, which is exactly why the math works differently. Two very different products dominate the market: modern resale condos, and traditional Machiya townhouses. A renovated Machiya in the historic center typically runs 80 million yen to 200 million yen or more. A standard resale condo, by comparison, is closer to 20 million yen to 30 million yen. And Machiya prices haven't been standing still. In the historic center, prices on renovated Machiya have gone up roughly 100%. They've doubled over the past 5 years. Here's why. Since 2007, Kyoto has run one of the strictest building height policies of any major Japanese city, under what's officially called the New Landscape Policy, designed to protect sightlines to temples, shrines, and the mountains that ring the city. Height limits step down in 6 tiers: 10m, 12m, 15m, 20m, 25m, 31m, from the city center out toward the surrounding hills. A parcel that could hold a 15-story tower almost anywhere else in Japan might be legally capped at 5 stories here, no matter what the developer wants to build. For an investor, that's the whole story in one sentence. New supply is structurally limited by law, in a city where demand keeps climbing. That scarcity is a big part of why central Kyoto property holds its value even when yields look thin on paper. There's simply no flood of new competing units coming to market. The same policy governs signage too. Rooftop advertising is banned citywide, and size and color saturation are capped for every sign in the city. Even national chain stores have to redesign their signage, smaller, muted colors, just to open a location in Kyoto, something you won't see almost anywhere else in the country. None of this makes Kyoto a high-yield city on paper. Typical gross rental yields run 3 to 4%, noticeably lower than Osaka or Nagoya. The exception is well-located, well-run short-term rental property, where gross yields of 6 to 10% are realistic. Legal, well-located short-term rentals are running occupancy rates of roughly 60 to 75%. Tourist demand for Kyoto specifically hasn't slowed down. But don't assume you can just buy a house and run it as a year-round Airbnb. Kyoto treats short-term rentals very differently from the rest of Japan. Nationally, Japan caps Minpaku-style short-term rentals at 180 days a year under the Housing Accommodation Business Act. That's the floor every operator in the country starts from, before any local city rule even applies. In Kyoto's low-rise, residential-only zones, the city cuts that down further, to just 60 days a year, and only during a fixed window, roughly January 15th to March 16th. If nobody lives on site, a local manager has to be reachable within 800 meters, about a 10-minute walk, and you're required to notify neighbors before you even open. Skip that step and you risk a complaint before your first guest checks in. And enforcement just got tougher. Starting February 2026, operators who miss their legally required report, due every 2 months, face faster business improvement orders, fines, business suspension orders, or public disclosure of the violation. On top of that, guests themselves are about to pay a lot more to stay in Kyoto. The city has been dealing with real over-tourism pressure, crowding, litter, and complaints about visitor behavior in popular districts, and it's responding through the tax code, which changes your pricing math too. Starting March 2026, Kyoto's accommodation tax jumps to as much as 10,000 yen, is almost equal to $62 per person, per night, up from a previous ceiling of 1,000 yen. The new tax runs on a 5-tier sliding scale based on the nightly room rate, 200 yen at the lowest tier, climbing to 1,000 yen for mid-range rooms, and up to that 10,000 yen ceiling for the most expensive stays, projected to raise about 100 million yen a year for the city. For a nightly rate near the top of that scale, the tax alone adds real friction to your pricing, on top of the occupancy limits we just covered, worth modeling both together before you assume a certain rate and occupancy will carry your numbers. Financing follows Japan's usual foreign buyer pattern. Residents with steady Japanese income can often get loan-to-value around 70 to 90%, while non-residents typically need much more cash up front, at rates closer to 1.0 to 2.5%. Looking ahead 12 months, forecasts put central Kyoto price growth at 2 to 5%, while outer wards are expected to stay closer to flat, 0 to 2%. The gap between the two comes down almost entirely to that scarcity effect we covered earlier. The fastest moving pockets, areas like Higashikujo, Kujo, and Umakoji near Kyoto Station, have seen prices climb 8 to 18% over the past 2 to 3 years, riding station area redevelopment. Expect a typical sale to take 90 to 120 days, with homes usually selling at 92 to 97% of the original asking price. There's real room to negotiate. In a genuine downturn scenario, higher mortgage rates, weaker tourism, tighter lodging rules all at once, prime central Kyoto could fall 5 to 10%. Older, harder to renovate homes further out could drop 10 to 20% and take years to recover. The single most common regret among buyers, falling for a beautiful old Machiya before checking its structure, road width, rebuildability, and fire safety. A charming facade doesn't guarantee a legally rentable, financeable property. The second most common mistake is assuming any house here can become a simple year-round Airbnb, when we've just seen how far that is from true. Put it together and Kyoto rewards patience and specificity. Scarce, well-located central property is genuinely protected by law from oversupply, but short-term rental income here is far more regulated and taxed than the tourist numbers alone suggest, and a rental strategy that works in Osaka may simply not be legal here. Next in this series, Yokohama, the Bay Area alternative sitting just outside Tokyo's most expensive postcodes. Kyoto isn't really a high-yield play, it's a scarcity play, backed by law. Know which one you're actually buying before you sign anything. Subscribe for the rest of this city-by-city real estate series, and for more data-driven breakdowns of living and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.